In the summer of 1998, four men sat in Greenwich, Connecticut, watching $500 million vanish in a single day. These were the smartest people in finance. Two had just won the Nobel Prize. One was Wall Street's most feared trader. Together, they built a machine so perfect it literally could not lose money. They called it long-term capital management. By the time the dust settled, this machine lost more money, faster than almost any private company in history, and came so close to detonating the global financial system that the Federal Reserve forced the biggest banks to save it. This is the story of how genius, arrogance, and one tiny Greek letter almost broke the world. Before we go further, if stories like this get your heart racing, hit subscribe and tap that bell, because Insolvent breaks down the biggest financial collapses every single week. You do not want to miss the next one. Now, let's go back to where it all started. To understand LTCM, you must understand John Meriwether. In the 1980s, Meriwether ran the bond arbitrage desk at Salomon Brothers, one of the most powerful investment banks. He had a gift for finding invisible mispricings between related securities. Multiply pennies by billions of dollars, borrowed at cheap rates, and those pennies become fortunes. This was relative value arbitrage. Bet small, bet safe, bet often, and use massive leverage to turn small edges into enormous profits. Meriwether became a legend. But in 1991, one of his traders submitted false bids in U.S. Treasury auctions. Meriwether hadn't ordered it, but as boss, he was forced to resign. He didn't disappear. He got more ambitious. In 1994, he built a hedge fund staffed with elite traders and the academics who invented the mathematical models Wall Street used to price risk. He recruited Myron, Scholes, and Robert Merton, economists whose work won them the 1997 Nobel Prize. He added former vice chairman of the Federal Reserve to build the Dream Team.
This is the opportunity of a lifetime.
The pitch to investors was simple. Give us your money, don't ask what we're doing, and don't touch it for 3 years. The minimum buy-in was $10 million. Wealthy investors begged to get in. For the first few years, LTCM looked like a money printer, up 20% in 1994, 43% in 1995, 41% in 1996. This fund used PhD-level mathematics to squeeze profit out of every corner of the global bond market. But here's the secret. Those returns weren't from spectacular trades. They came from spectacular leverage. Each trade LTCM made was tiny. To turn fractions into 40% returns, the fund borrowed unimaginable amounts of money. By 1998, LTCM's own capital was around $5 billion. But the total value of assets it controlled exceeded $125 billion. That's a leverage ratio north of 25 to 1. And that number hides the real danger. LTCM wasn't just borrowing money. It held derivative contracts with a notional value exceeding $1 trillion. That was close to 5% of the world's economic output, controlled by a private partnership in Connecticut. Wall Street's biggest banks weren't worried. They competed to lend LTCM money. Meriwether's reputation was so powerful that banks waived collateral requirements. Nobody said no to Nobel laureates. The partners believed their models solved uncertainty. Their computers calculated that a loss big enough to threaten the fund was mathematically impossible, something that should happen once in the lifetime of the universe. They were about to find out how wrong that number was. Every downfall has a moment where invincibility meets reality. For LTCM, that moment was Russia. In August 1998, the Russian government did something LTCM's models assigned almost zero probability to. It defaulted on its domestic debt and let the ruble collapse. markets panicked, breaking every historical pattern LTCM's models were built on. Here's what LTCM never accounted for. In a panic, correlations don't behave the way history says they should. Assets that were supposed to move independently started moving violently in the same direction. Investors rushed toward the safest assets on Earth, U.S. Treasury bonds, and fled everything else. LTCM was positioned on exactly the wrong side of that stampede. On August 21, 1998, LTCM lost more than $500 million in a single trading day. That was just the beginning. Through the rest of August, the fund's losses piled up to $1.8 billion, wiping out more than half its capital for the year. And here is the trap of leverage. When your capital shrinks, but your positions don't, your leverage ratio explodes. As LTCM's equity bled out through September, estimates put its effective leverage at over 100 to 1. The fund needed to sell assets to survive. But its positions were so enormous, so tangled into every major bank, that trying to sell would crash the markets it was trying to escape. LTCM had become too big, too tangled, and too dangerous to fail quietly. This is where the story stops being about one hedge fund and starts being about the global financial system standing on the edge. If you find this as insane as I do, hit like right now and drop a comment telling me what surprised you the most so far. It helps this video reach more people. Okay, back to Wall Street, where the Fed steps in. By late September 1998, word spread. Long-term capital management was about to collapse. This should not have been a national emergency. LTCM was a private partnership, not insured, not regulated like a bank. In theory, only its investors should suffer. But regulators at the Federal Reserve Bank of New York saw something scarier. LTCM's trades weren't isolated. They were the counterparty to nearly every major bank. If LTCM collapsed and dumped $125 billion in assets onto panicked markets all at once, the shockwave could crash bond, stock, and currency markets across the world simultaneously. On September 23, 1998, the president of the New York Fed did something extraordinary. He called the CEOs of 14 of the largest banks, names like Goldman Sachs, Merrill Lynch, JP Morgan, into a room and told them, "Fix this yourselves right now, or we all go down together." It's crucial to get this right. The Federal Reserve did not spend a single dollar of taxpayer money bailing out LTCM. No public funds were injected. Instead, the Fed used its authority to organize a private rescue, pressuring the banks to step in because saving LTCM was cheaper than letting it explode. Under pressure, the banks agreed to inject $3.6 billion of their own money in exchange for 90% ownership of what was left of the fund. The two Nobel laureates and the legendary trader were left holding roughly 10% of the wreckage they built. It worked. The controlled collapse gave LTCM time to unwind its positions slowly. The global financial panic never fully arrived. But the message to the world was unmistakable. The smartest minds in modern finance, backed by Nobel Prize-winning mathematics, had come within days of triggering a global catastrophe. Long-term capital management was formally wound down over the following 2 years, fully dissolved by 2000. Outside investors walked away having lost most of what they put in. The partners lost the vast majority of their personal fortunes too. Myron Scholes and Robert Merton saw their life's academic work publicly blamed for nearly detonating the world economy. It was a brutal irony. The same equations that helped build modern Wall Street had also fed the overconfidence that almost destroyed it. John Meriwether didn't disappear. True to form, he started a new fund the following year, smaller, less leveraged, but built on many of the same strategies. It survived for years, until the 2008 financial crisis hit it hard too. And that's the most unsettling part of this story. The lessons of 1998, that leverage can turn a tiny miscalculation into a global emergency, that impossible risks happen more often than elegant math predicts, that being too interconnected can be just as dangerous as too big, Those lessons were written down and published in official government reports. And 10 years later, in 2008, almost the exact same mistake happened again. Except that time, it wasn't one hedge fund in Connecticut. It was the entire global banking system. Long-term capital management is proof of one of the most dangerous ideas in finance, that intelligence can replace humility. 2 Nobel Prizes, decades of trading experience, and the most sophisticated risk models Wall Street had ever seen. None of it was enough to survive a market that refused to behave the way the equations said it should. If this story hit you the way it hit me, make sure you're subscribed with the bell on, because I cover a new financial collapse like this every single week. Drop a like if you made it this far, and tell me in the comments, do you think this could happen again with an even bigger fund right now? I read every single comment, and I want to know what you think. Thanks for watching Insolvent. I'll see you in the next one.